So many indicators that points to a recession, and I use this as one of my warning indicators because it's one of the best. As simple as it sounds, employment. Think about it. It is the most basic function indication of the economy. If companies are not hiring, it means less business, less people, there's less spending and less profits. It is a domino effect. So you need to understand, when unemployment is rising, it could be due to various reasons. Today, demand for goods and services is sky high, causing freaking inflation. When you see a recession coming, it's most likely led by unemployment. When you see people lose their jobs, earnings goes down, businesses cut back, and people cut back because they're scared of their jobs. Does that sound like today? It's the total opposite. It's a freaking booming economy. This is not a bad economy. People are loaded with cash. In fact, sometimes you hear about the Fed pulling liquidity, but do you know that the largest stimulus check is coming in this March, April or February? $1,500 to $1,800 tax credits per child. This will pump more money into the system. So wrapping up, as mentioned in this video, where CPI is higher than the 10-year, which means historically this will lead to the biggest bull market we will see. Granted that this year is not an easy year, but once this is over, we are off to the moon.
All right, folks, here's the quote. When you see a recession coming, it's most likely led by unemployment. When people lose their jobs, earnings go down, people cut back. Today's the total opposite. It's a freaking booming economy today. We're off to the moon. Those are two quotes. The "we're off to the moon" part is pretty close to this. But this was the thesis here, is that, okay, when you see a recession coming, it's most likely led by unemployment. And I thought to myself, okay, so maybe we should look at charts on unemployment to see if unemployment's going up, because actually it sounds really exciting. My gut says unemployment's actually really low. If anything, it's falling. And it makes me want to invest everything I have and flip-flop, and that way I can also be on the rocket ship that goes off to the moon. See, I know that everyone's spending money like crazy. I know people are getting paid like crazy more than ever before. People are getting paid so much so that household checking account balances have never been this high. It's amazing. Things are booming right now. Look at earnings from the fourth quarter. Everybody's spending all the money they got. Parks at Disney had their revenue beat expectations 17% because people are spending so much money. People feel so rich that 50% of people are upgrading to skip the line. You don't usually see that kind of stuff. The per capita spend at Disney is the highest it has ever been before. That means even though you could have less guests going to Disney World or Disneyland, people are spending more money than ever before. The booming economy, it's true. So when they say that a recession coming is most likely led by unemployment, I'm curious about this. So I think to myself, okay, well, I'm a numbers guy, okay? I like statistics and facts and logic. Unfortunately, those things are not extremely popular on YouTube, but that's okay. Let's go ahead and look at the chart, and let's see if we can corroborate this thesis. So this here is a chart of our unemployment rate in the United States. The gray lines here are when there were recessions, and the spikes in the blue lines here are spikes in the unemployment rate. So let's go ahead and zoom into, let's say, 08. Obviously, the pandemic was a little interesting. We could zoom into the pandemic, too. So it looks like we actually were in a recession while the unemployment rate was still 3.5%. Let me hide myself there. Look at this. We actually entered into a recession when we went from 3.5% to 4.4%. But we were almost done with the recession by the time the unemployment rate skyrocketed. Okay. What about 2008? Maybe that's an anomaly. Okay, 2008. Looks like the recession started technically over here in the early half of 2008. We had a stock market crash in September of 2008. The unemployment rate had gone from 5 to 6%. But wait a minute. It didn't actually skyrocket until the stock market, until beyond, like after, when the stock market already bottomed in the first portion of 2009. It looks like it actually peaked in October of 2009 well after the stock market had already substantially recovered. Here in the dot-com bubble, looks like the crash was really here end of 2000, 2001. Unemployment rate didn't really start going up until the end of 2001. This is interesting. It looks like the same that's true of the 2020 recession, the pandemic recession, the recession of 08, the dot-com bubble, the 1990s recession, the early 80s recession, the 70s recession, the well, we got that one, both of the recessions in the 80s there, and then in the 70s. Wait a minute. Every single time there's a recession, it looks like the unemployment rate goes up after we go into a recession. So, but wait a minute. The quote that I'm being told everybody's freaking out about and being so excited about is, when you see a recession coming, it's most likely led by unemployment. But wait a minute. According to the statistics, it actually looks like a recession happens first, and then unemployment goes up, which kind of makes sense, because if you're a business and you think things are booming, why would you lay people off? It's only when we're in a technical recession. That's when businesses appear to start cutting back, at least based on the facts. Let's see if we can learn a little bit more here. Oh, what's this? Investopedia, lagging indicators. They can clarify and confirm a pattern that is occurring over time, but lagging indicators can only be known after the event. That doesn't make them useless, but they're known after an event. The unemployment rate is one of the most reliable lagging indicators. Oh, crap. So we probably shouldn't be looking at the best indicator of a crash ever, the unemployment rate, because then we'd be really far behind the curve. If the unemployment rate rose last month and the month before, it indicates the overall economy has been doing more poorly and may continue to do more poorly. Right. The unemployment rate is a lousy recession indicator. If you want to time the next recession, the unemployment rate is the worst place to look. The unemployment rate was low when the market crashed in September of 08. We just saw that on the chart. And kept rising way after the recession ended in March of 09. Remember, the Fed bailed us out in Feb of 09. The unemployment rate is such a bad indicator of how well the economy is doing that it did not start increasing until 5 months after the official start of the recession of December 2007. Here's some more research as well. What's this? The unemployment rate is often used to indicate economic strength, but is also a lagging indicator. Low unemployment is the result of economic growth, not a precursor. Huh. Okay. So, wait a minute. Then we're getting duped when we're being told if we just look at the unemployment rate, we're good. Now, that's not to say that if unemployment is low, the opposite is true, recession is coming, right? It just means that if individuals are telling us, hey, Kevin, everything's fine, there can't be a recession because unemployment is low, and unemployment is a leading indicator, it looks to me like whoever's saying that is either wrong, uneducated, or trying to deceive people into thinking that we're actually heading to the moon when that's not a fact or potential rationalization to say we're even remotely heading to the moon. Now, other things could say we're heading to the moon, but this is not one of them.